The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals Podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode of the Fundamentals Podcast, we're joined by Chris Abiaad, the founder of Frens Capital, a thesis-driven investment fund focused on liquid digital assets. Their strategy is to make long-only investments based on fundamentals and the core principles of value investing. In this episode with Chris, we discuss Frens Capital and break down their investment strategy. We discuss what makes web3 interesting from an investor's point of view, and we also break down liquid venture and why it is a superior form of investing compared to traditional VC. We speak about the differences between Web2 and Web3 business models and moats, and also speak about some 0 to 1 tech unlocks that could open up the space for mass adoption. In addition, we get to hear what Chris is most excited about in this space right now, and much more. So tune in for a great discussion about the fundamentals of value investing in crypto. I don't know about you, but I woke up feeling pretty bullish today, actually. I don't know, this market really gets my emotions going up and down. But today I had a very optimistic feeling. I think this is my fourth pod recording of the week, and just the builders and how everyone is feeling right now. I feel like the past few weeks, the momentum has shifted in the right direction. I don't know how you're feeling right now in general about the market.
Very optimistic just from a macro standpoint, but I think that the heartbeat of crypto has not missed a beat really. Even throughout the bear, going to conferences and meeting builders, meeting teams, it seemed like everybody's still shipping. The environment gets harder, and it basically creates a survival of the fittest environment, which is good for crypto.
I love that. That's really well framed. I know that sometimes, I wake up, something happens in the market, and I just feel almost embarrassed, just pulling my cap down on top of my eyes. Okay, just got to focus on what matters. It's fundamentals. That's why it's engraved onto my cap. And I'm excited to chat with you. So, hey, Chris, welcome to the Fundamentals Podcast. This is going to be a fun session to dive into Frens Capital and why you are in this space as well.
Absolutely. Thanks for having me on, Scary.
Now, before we dive into Frens and just crypto in general and what makes it unique from an investor's perspective, could you give a quick introduction to yourself and your background, so how you got to where you are now?
Absolutely. I'm Chris Abiaad, the founder and general partner at Frens Capital. Fell down the crypto rabbit hole in an interesting way. I was attending Cornell Tech. I enrolled in this blockchain course. It was the first university to offer a blockchain course. That was in 2016, 2017. When I started the class, Ethereum was trading at $10. By the end of the semester, it was at $300. Maybe this is lucky timing, but I got fascinated by the technology, by the market, and most importantly, by the ideals that crypto stands for. Due to the massive wave of ICOs back then, there was no well-defined process to select solid crypto companies to go work for. So I ended up joining the data side of the world and AI side of the world, where I worked in product and knowledge graphs and machine learning. My background is in Web2 as a product person, and I was drawn to the technical fundamentals of crypto as well as its ideas. And throughout my Web2 journey, I was still excited by the promise of crypto and spent my vacation time attending conferences, networking my way in, and eventually advising crypto founders on go-to-market and product. Fast forward to the previous bull run, I decided to finally make a formal move into the industry. And I was fortunate enough to be backed by a strong network of LPs and friends around me who trusted me and trusted my judgment on the topic.
Yeah, sounds familiar. That's definitely something that I think a lot of people in this space can resonate with. You start with your free time, just, diving into all the content available, engaging with the communities, and all of a sudden you find yourself in a situation where, hey, it actually doesn't make any sense for me to focus on anything else. I feel like the opportunity cost is too high. I got to go full time into crypto. Happened to me. Sounds like it happens to you. We're not alone, but that's awesome. I love it. Now, at the moment, you run a fund called Frens Capital. Would be awesome to kind of get the story behind what got you to found that, and then also a walkthrough of what Frens is all about in terms of the fund specs and your investment strategy and all that.
So Frens Capital is a long-only liquid token fund focused on fundamentals. We invest using a three-prong approach, looking at macro, looking at crypto sectors, and then looking at category-winning projects. We also built a strong network of advisors, and together we launched Alexandria DAO, a research DAO that aims to cover the breadth of the crypto markets. So I think that there's two huge opportunities in crypto today. And first one being is that the space is not well defined and the fundamentals is not well defined. These business models are still new, and the key metrics and how to get the data is still difficult. The second thing is that I believe that crypto is going to impact different areas of the market. Like we already see in conferences, investors interested in generative art and on Ethereum don't know much about NFTs on Solana, for example. And then folks in the Cosmos ecosystem do not understand the Bitcoin ecosystem per se. So basically, the opportunity there is how to cover the breadth of the markets.
So when you say the Friends Capital is a thesis-driven fund, the thesis there really is the focus on fundamentals, right?
Yes.
And how would you maybe elaborate even a bit more on what that actually means from your perspective? What are fundamentals in crypto?
I really think that it looks a little similar to the lack of definition that the software as a service industry, that the SaaS industry had in late 2000, early to 2010s. These business models were not properly understood. And people thought that these companies were just burning cash and never going to see that money again until you saw these network effects being and just category winning companies in Web2 really creating dominance. So I think that basically crypto mimics this with an amplifying factor being that the data is transparent, the data is streamed, it's continuous, and all the data is on chain. You want to see how many users a protocol has, you can check it right away. You can get it per minute. It's much harder to do this with a centralized Web2 company. But the overall thesis is that we believe that any asset that can get tokenized will eventually get tokenized. I think that by becoming tokenized, it will inherit all the properties of blockchains. Like it's going to be permissionless, decentralized, transparent, immutable. And these are extremely important properties that the world does not know how to value today.
Yep, it's a complicated space. There's a bunch of asset managers out there who all have kind of eyed towards crypto, but then many kind of don't take the leap into it, or it just seems a bit too hard to approach. So that's why we need asset managers like you who allow LPs to get exposure to this asset class. Now, how would you describe the core problem that you solve for LPs?
We have them outperform Ethereum and basically holding a neat position. We often tell our LPs that the ones that are not very familiar with crypto to invest in BTC and ETH themselves and self-custody if they can. Many investors do not want to learn about crypto. They don't want to hold it through its volatility, and they don't want to learn about self-custody. It's still difficult to really understand how to stay secure and how to approach the crypto markets. They are also interested and attracted to the return profiles that the rest of the crypto tokens, mainly the underdiscovered tokens, offer. And that's where we come in. And when the time is right, with proper diligence, that's where we come in to evaluate and take positions in underdiscovered tokens.
So from like your personal experience, do you see that there is like a really clear demand from the LP side for exposure to this asset class, and it just comes down to it's just too complicated? Or is it more of still very experimental for them? It's not a core part of portfolios. Like how would you say LPs position kind of this asset class right now?
I want to say that every large asset manager out there has already looked at crypto. Whether they include it as part of their portfolios or not is a different story. We're seeing these numbers go up. But what I would say is that for smaller LPs, what happens is that crypto is very much sentiment driven. As we see with the media, when Bitcoin hits all-time high, all these magazines and newspapers and publications start saying that Bitcoin is the next big thing. And then when it hits all-time low, it says that it's going to zero. So basically, because it's sentiment driven and people don't really understand what crypto stands for, the ideas that it's really enabling, it very much has to do with the liquidity environment. And as we can see, when liquidity gets scarce, crypto is one of the major areas and the first areas to get affected first.
Yeah, and as we're speaking about liquidity, I think it would make sense to kind of bring up the topic of liquid venture, because that's one of the biggest differences between traditional venture capital and then venture capital in crypto, where in the traditional world, it's actually quite time consuming and complex to allocate capital because they're not liquid markets. You're buying shares of companies that aren't public, lots of pen and paper contracts involved, no liquidity available. It's just a completely different dynamic. And then what crypto introduced is that you have these same early stage startups that just happen to be public from pretty often almost day one. As you are kind of on the forefront of this liquid venture investing, could you give us a primer into what the main differences between that and then the more traditional model of VCR, and then the pros and cons of both?
Absolutely. That's a great question. And I think first it might be good to define what liquid venture is. And I think it sits between the public and private equities / securities space. And I say securities here because as we know that like we can't talk about liquid ventures without without talking about regulations and really how these tokens are going to be regulated. So what liquid venture essentially enables is it enables investors to make investments in early stage companies while keeping access to their liquidity. And what it does is that the growth of a crypto company ends up following a smoother curve when the market is constantly pricing and repricing the value that this company is delivering, as opposed to the traditional venture where the valuation follows more of a staircase approach, where often they double and triple in valuation from one round to the next. So besides that, it gives a direct path to liquidity and avoids undetermined lockups. This is what traditional venture is signing up for, with determined lockups. It increases optionality, and most importantly, it allows the pace of investing to adapt to the change of pace in the technology in which they're investing. So I see traditional ventures is looking 7 to 10 years ahead. This in tech is a very long time. It's very hard. It's very hard to know what companies and what technologies are going to be successful in 7 to 10 years. In crypto, 7 to 10 years is an eternity. So rather than forcing a super strong timeline, I think that projects and investors can align on shorter time horizons and both benefit from that. I also think that liquid venture and this liquidity in crypto is superior for employees. In Web2, early employees often get binary outcomes. They either make a lot of money when the company goes public, or they don't get much out of their equity. So a great company today might not be so great tomorrow, since innovation is so fast. And then lastly, I'd say that like the crypto markets are 24/7 global markets. They have 5 times more uptime than traditional stock markets, but of course, way less trading volumes, but they're available 24/7 around the clock across the world. And this around the clock liquidity can offer great returns, but also comes at a high risk of volatility and downsides as well.
It does. But that is a really important note to bring up as well, that like liquid venture has benefits for pretty much all stakeholders involved. It's not just investors. Now, as a venture fund in a liquid venture space, when you invest into projects with a long-term investment horizon, I assume you work with them to some extent to help support their operations. Is that assumption true? And if yes, how do you work with the projects you invest in?
I'd say the answer is yes for early stage projects, mainly because they need this active help more than larger projects. So we come in 3 ways. First one is we can provide liquidity, mainly in the early stages of bootstrapping a DeFi or NFT-fi protocol, provide product feedback, mainly related to go-to-market and UX. That's where I see myself with my background and experience as an extension of the teams I invest in. So I want to be a user and I want to be a liquidity provider and I want to give clear feedback to them and make introductions to help them increase their go-to-market. And finally, and most importantly, I think taking a position in a liquid token that we typically hold for a year plus is how we also help projects.
Yeah, great. So long-term horizon in crypto, from your perspective, it's 1 year plus. That's what we're like talking about.
Yes, I'd like to think longer term, but
It's long in crypto.
it's 1 year is already long in crypto. Yes. Now this is ideal. It does not mean that as active investors, we grow our exposure or reduce our exposure depending on the liquidity market, but also depending on the performance of these companies.
We covered quite a bit about what makes crypto interesting, both from the aspect of markets being open 24/7, everything just being transparent and auditable, the liquidity aspects, how they benefit all stakeholders. But if we dive a bit deeper into what actually makes this whole sector of crypto interesting from an investor's point of view, what would be kind of the main topics that you would bring up there?
There's a lot to say. I think that like crypto's ethos and the ideas that it stands for are really noble, mainly because it's creating a more fair version of the internet. And today, the largest economy is already the digital economy. This digital economy is growing 2.5 times faster than the rest of the world's GDP. So what Web3 is doing is that really making the internet more transparent, less centralized, eliminating single points of failures and single unappointed authorities. And that, in my view, is very important. A lot of things should not be left in the hands of such a few people to decide. And that's what we see in Web2 today with big tech. They really provide amazing products with economies of scale, but they ended up, whether voluntarily or involuntarily, becoming the referees of something like freedom of speech of what's allowed to say and what's not allowed to say.
That's true. And the kind of counter to that from an investor's perspective would be that, well, actually, these gatekeepers to the internet, these big tech companies who centralize everything, they've been great investment opportunities. They're just able to extract value from everybody and anybody who wants to build something in Web 2. So when we think of like Web 3 and how the investment opportunities kind of shape out in that space, can you kind of speak a bit about how you view Web3 business models compared to Web 2 and how different power law dynamics play out between those two?
It's a great point that you make on Web 2 companies being extremely good investments. They build amazing products. And for that, there's no reason they shouldn't capture that value. Now, the thing is that have they captured a lot more value than they should? That's a question for new players to basically build more competitive products. And that's what we're seeing in Web3. I think that like the ultimate business model in Web3 is the one with the highest product market fit, is selling block space. Layer 1 blockchains are selling space on their blockchain for users and developers really to store information and run code. It's more trustable than centralized parties. And basically the success of Ethereum, Solana, Cosmos is already proof that developers and ultimately users want stronger commitments from their database and than what is currently offered. Now, this is, I would say, the biggest use case today. There are the biggest use case and business model that presents the largest opportunities. Now, there are other successful business models that have found strong product market fit as well. And I would say these are decentralized exchanges, NFT marketplaces, stable coins, and more recently, layer twos. And I really enjoy auditing this by checking the chain and looking at which application are consuming the most gas. And as you can see, this does not change much over the months. The same apps are always on top. And that tells you that basically they have the strongest market fit. Well, you asked about power laws. And I think that what power laws are is that they mean that a small minority of investments are going to generate the majority of returns. And so far, with the exception of a few tokens, it has been a consistent challenge to outperform Bitcoin or ETH. And that's what folks like us are on the lookout for. Using token terminally, by the way, we can already find the most successful business models, cash flow they generate, the initial hint at power laws taking shape. I noticed the new market sectors module that you guys launched. And there's a little stat at the bottom that calls out the dominance for every category. And these dominant players are effectively capturing the power laws already, at least from an activity perspective. And as I was looking at it, I was looking at DEXs, for example, Uniswap dominance at 60% of all trading volume. For lending, Aave has 55 dominance in active, 55% dominance in active loans. Now, there are instances where the power laws are even more amplified. If you look at bridges, Stargate Layer 0 is at 90% dominance for bridges transfer volume. Lido, for example, is taking 85% of every new ETH that is staked. In fact, for this, I ran an analysis, but to show that if Rocket Pool was growing at 20 times the growth rate of Lido per month, it would still take a year to catch up to Lido and TVL. Now that's 20 times faster growth. And just for context, last month, Rocket Pool grew by 10%. Its TVL, Lido grew 8%, by 8% in CBL. So 20 times is extremely far-fetched, and it'll still take a year. So what I'd say is that basically this fundamental utility that these projects are establishing is what will eventually generate the returns of these power laws. And while a lot of retail traders are pursuing the next shiny objects, these dominant players are just continuing to establish their dominance.
That is a really great point, and I'm also happy to hear that you found the new market sector module useful. I was pretty happy to get that live finally. One thing that is quite interesting in terms of how the power law dynamics have played out in crypto is that I feel that moats in Web 2 were much more clear. It was much easier to build a moat with closed source development and everything else, whereas in crypto everything is open. And simplifying things a bit, when you build something and launch it, practically anyone can come out and fork it and build the exact same product and vampire attack you and incentivize users to come and use you. But still, we're seeing the number one players grow according to these power laws and capture the majority of the market. Could you maybe speak a bit about how you view moats in crypto and just in general, whether there are moats and how projects should be thinking of those?
Absolutely. And I think you're absolutely right about Web 2 and the Web 2 moats, but I think that we're looking at them in retrospect. And today, for example, if we look at social networks, we can understand the moats. They're well understood. But from 2005 to today, how many attempts has there been at a new social network company? So many that failed. So basically, still people believe that they can displace these network effects and displace these modes. And I think that in retrospect, we understand these modes. Today in crypto, we're still super early, and I don't think that these modes are extremely solidified yet. So many things can change. Eventually, with time, they will get solidified. So, for example, the players I mentioned earlier, these are folks that are crystallizing their modes, solidifying their network effects and grow. And what I see, for example, is that TVN has strong network effects, and capital does provide some sort of leverage. It becomes hard to compete with an ecosystem that has a lot of value up for grabs by the best builders, users, and investors. And I think Lido and Arbitrum are excellent examples of such execution. They attracted extremely large pools of capital to defend their offerings. They solidified their modes this way. And we've seen time and time again, users are not necessarily drawn to the best technology. They want to use the best dApps. And these best dApps are building on ecosystem that have large amounts of capital. So can't be debatable whether Arbitrum is better or less better than Optimism. But what we cannot debate is that Arbitrum has close to 3 times the amount of TVL in its ecosystem. That's a metric that we can evaluate, we can see. And basically what this does is that it drives more builders to that ecosystem. So I think one important point here in Mode is looking at TVL and really stickiness, understanding how sticky is that TVL. We've also seen how easy it is to bridge funds from one ecosystem to another. And some incentive programs can be very predatory that can really push people to move their capital from one blockchain to another. So looking out for TVL stickiness is going to be very important in establishing those modes.
That makes sense. But yeah, that was also a good answer. I think the stickiness is pretty important. I mean, this isn't a one-to-one comparison, but if we think of like Web2 venture-backed businesses, you think about churn as a metric, and you optimize that. You just hide your cancel subscription button as good as you can and set up all sorts of like long-term payment terms. You don't have that in crypto. As soon as there is a more financially lucrative opportunity for someone to switch to use another protocol or a better UX or something else, a rational user would switch. So I mean, that stickiness is definitely something that you need to look at and understand what the drivers are behind it. So great points there.
One thing actually here, people are products of habits. And I think that basically, if you look at Google and Bing and you were to compare their search results, you cannot differentiate between both. People wouldn't be able to call out what is a Google search result versus what's a Bing search result. Now, the thing is that because we're products of habits that we develop, what happens is that we're just used to Google and therefore we go to Google and conduct our searches there. So I think that while churn can be much higher in crypto, we're still the same people. And we're going to develop habits. And if we're used to trade on an NFT marketplace or on some DEX, and we build that habit, we probably wouldn't need that easily.
Great addition. That's how it is. I mean, it's easy to kind of try to over quantify and over simplify these things. Maybe like how I was approaching it, it's like, oh, that's how a rational actor would work. But you know, human beings aren't rational actors in most cases. So you're 100% right. But I think one of the biggest attractions in crypto from an investor's perspective has definitely been the fact that, you know, the world's most valuable companies are born during these major platform shifts. And I would argue that the shift to Web3 and to crypto is a pretty massive platform shift. When we think about like the biggest 0 to 1 moments up until now, we have something like Bitcoin that unlocked digital scarcity, which enabled value to be transferred online without intermediaries. Then you have smart contract development platforms that came out and app chains, etc. So we've just gotten to us where we are now. But still, we're at a stage where, you know, we haven't had the big unlock that's unlocked like mass adoption, and we're kind of still waiting for something to happen. So if we look into the future, what would you see as being kind of the biggest tech unlocks that you're most excited to see happen?
That's a great question. I think that, as I mentioned earlier, I think we're absolutely still early. I think crypto has about 5 million daily active users. Chess.com in one day had 20 million daily active users. So basically, we're still super early. And I think that like there's some interesting technologies that will unlock the next wave of participants. One that I really like, I think, is Chainlink functions. It's still in beta, but basically what it does is that it allows any API to get onboarded on chain. Basically, what it would do is that it would take a lot of apps that we've seen in Web2 that have a lot of data to basically get onboarded onto crypto in a much easier way while inheriting the security from Chainlink. That's one that I think would create a much broader set of use cases and dApps that can be built on chain. The second thing I think is related to user experience and account abstraction in its finest state, not where it currently is, will improve the UX by an order of magnitude. And it would allow crypto to actually significantly accelerate its growth. I think this is really the next chasm that crypto needs to cross. And today, asking users to self custody is definitely a bottleneck that we have for crypto. Now, I would like to encourage self custody, but we should basically meet users where they are today. And I hope account abstraction would unlock this. I think also layer twos are so interesting. As Ethereum continues to grow, its current limitations will be a thing of the past. Like transaction costs are going to trend towards zero. And eventually, like all these layer twos will inherit Ethereum security and benefit from an execution that has high throughput, which will also enable new use cases that were not possible before. The last thing I'd add, just because it's very topical right now, but I think that liquid staking, but I don't necessarily see it giving birth to a new set of applications. I see a lot of people talking about LSDFi. I think of it as it's just DeFi or just a different basis. So it's not necessarily enabling a completely new way. Now, I think what it's enabling is that it's enabling new types of applications at a protocol level. And I think mainly the most exciting ones are distributed validator technologies that will increase the security of these validators without creating centralized points of failures and will really reduce the risks of large liquid staking providers like Lido. And I think also the concept of restaking and shared securities across chain. This is what Eigenlayer and Babylon chain are doing is also super interesting. Keep an eye on.
Yeah, those are all really interesting things to follow and see how they develop. Even though saying that we're early has become a meme, it's just still factually true. I mean, from an investor's perspective as well, we don't have a flood of capital allocators in the space yet, especially if we're comparing to the traditional world, whereas that's going to result in some sort of market inefficiencies because we don't have similar levels of investor consensus, we don't have similar levels of arbitrageurs, we don't have the same level of liquidity as traditional public markets, et cetera, et cetera. How do you see, from an investor's point of view, in this market that they need to be kind of acknowledged? What is the effect of the current market efficiencies and the state of them?
The market inefficiencies I'm focused on are really related to fair valuations of these projects. And basically what they create is they create more opportunity for investors like us. I think that as the space gets better and better defined, the underlying methodology of calculating these core metrics is going to be more important than the final number that we arrive. It's often difficult to agree on fees. Some expenses in DAOs and projects are opaque. But as long as methodologies are consistent, like what you guys are doing very well in Token Terminal, this data can be used as a good proxy for a given sector. But I would also say that while the introduction of revenues and fees from Token Terminal shows an excellent pictures of some projects, people often think that we miss the fact that a lot of these projects are still in their early stages and they're focused on growth. They're not looking to optimize their revenues or their fees yet, but they're looking to continue their growth. And what I would say is that kudos to Tucker Terminal, you really spearheaded the focus on fundamentals and financial fundamentals of crypto projects. It served me many times with LPs and friends as an aha moment for them to understand that some of these projects are generating revenue, they're distributing dividends back to token holders, etc. So this is awesome. And I think that as well, Token Terminal does serve as an excellent project discovery tool and diligence tool. And as these metrics continue to get built, I think there's going to be metrics that are super interesting to look at, like things like TVL volatility, users graph data, the users in a given project's purchasing power, and basically better understanding of the expense sides of those DAOs and projects to truly understand their profitability.
I feel quite privileged, honestly, to be in this position where we are right now. We're able to speak with like both project teams on a daily basis, get the really granular info on how they would want to track their progress, what the key metrics are that they feel are the indicators of performance in their business. We also have the other side where we get to speak with investors who are both crypto native, and now most lately with the integration with the Crypto Fundamentals app into Bloomberg Terminal, also get the perspective of traditional investors who are looking at from how do I compare Uniswap to Coinbase? a public listed company. And you really need to start building like the valuation frameworks and the methodologies in some way that's comparable, that investors understand them, because the big capital allocators will want really strong and robust frameworks that they can just apply their own like investment processes to. And as long as we keep the methodologies open, clear, transparent, then the importance of this like qualitative context that we bring through interviews and different analyst coverage, which is coming to the site, it becomes increasingly important. But yeah, you're completely right on what you said there.
And I think I just emphasize here something related to relative valuations. And I think that basically, if you start with Bitcoin and you try to determine the fair value of Bitcoin, there are many methodologies to do this. There are different reasons why it's very difficult to do this. And ultimately, all of crypto is in price discovery mode. And what happens is that rather than looking at the exact fair valuation of a token or project, it's important to look at the relative valuation per market sector and what are the catalysts that basically would make a certain project grow over their competitors in their market sector. And that's a better way in my opinion, to identify the fair value of a project.
Now, I want to speak quickly about very practical level of how you make investments. So would you be able to speak a bit about your deal sourcing process, where you start from, how you identify potential investments, how you conduct due diligence on them, and how the like final decision making happens?
So then I mentioned token terminal being great for project discovery because it's a great place to look at different sectors and the relative valuations of each project. Now, I think long term, we're going the same way that the SaaS industry has a plug and play model where you really have CAC, CLTV, MRR, churn, etc., and output evaluation. I think crypto is going to have the same valuation frameworks, even more amplified because you can look again at data in real time. So for deal sourcing, I do start with token terminal, and I also look at other places mainly related to ecosystem that form around this technology unlocks that I mentioned earlier, right? Because I believe that these will really be 0 to 1 moments for those ecosystems and what can they drive. So first thing I would say is that what we look at is we want to understand the business models. So we spent a lot of time on the sectors. We use macro to basically as red, yellow, green. Light, we want to increase exposure, lower exposure, not be exposed, etc. And we focus on the sectors. And then once we understand the sector well, that's when we pick a winner or a challenge in this. So basically, what I do is that once I understand the business model, I want to dig into the users, fundamentals, developer activity, the incentives, the unlocks, latest VC rounds, if any, and their valuation, and look at the ratios that token terminal offers as well. This is where I think that this is a good place to start by looking at a little bit of everything while really focusing on this. What I would say is that today, a lot of investors also look at market cap and fully diluted valuation. And while these are two metrics that are super simple, but they're also overly simple. So what happens is that there are two ends of a spectrum. And oftentimes, if you use one or the other end to calculate your ratio or to look at the valuation, you're probably either overshooting or undershooting. That's what the true valuation is. The reality is that how does the curve look in the middle? How are these unlocks looking and how long is it going to take to effectuate this valuation? So we have, as mentioned, we have a long-term crypto mindset and investment horizon. So we tend to look and to want to hold positions for a year plus. And more importantly, we tend to think about where the marginal buyer will come from. And it's usually where the most developers are, because the net new buyer is probably the net new user. So right now, what I'm excited about is, for example, the growth of the super chain on Optimism, base, essentially onboarding millions of users, mainly really activity around layer twos.
That makes sense. And I think basing this off what we've discussed in this session already, I know there are investors who focus a lot purely on cash flows, but I feel like your approach is a bit different. You know that cash flows come into play at a certain stage and a certain maturity of a company. But before that, we're looking at growth stage businesses where maybe cash flows aren't the core indicator. And you also spoke about block space and maybe the utility of block space being one of the things that you would first look at. So gas expenditure, which chains are having most activity activity on them and who is spending the most gas. So could you maybe summarize what the main KPIs from your perspective are that you really focus on and how you kind of rank them in terms of relevance?
Yeah, I like how you framed it because I think that like actually cash flows are sector dependent more than stage dependent. So I think that if you look at Chainlink, it's more mature than GMX. Its cash flows are relatively non-existent today. Its fundamentals from a utility perspective are extremely good, right, for Chainlink. While GMX operates in a different sector where cash flows are more the norm and cash flows can be realized right away. So I think that I will use cash flows depending on the different sectors. So for that, and really I think I already touched on the majority of the KPIs I look at, but in general, what I very much enjoy doing is looking at developer activity and usage.
On the KPIs, one thing I want to ask is related to token incentives, because this is one topic where, of course, on Token Terminal, we have an earnings metric, and we, of course, showcase token incentives because they play a pretty big role in crypto in general. And our earnings metric is revenue generated minus token incentives, which would be the earnings of a protocol. And this is one that there is a lot of back and forth with different communities, especially communities that have lots of token incentives who might not want to see those as expenses to the protocol, how we frame it. So I'm thinking from an investor's perspective who is actually purchasing tokens, how do you view token incentives? Are they an expense to a protocol or is there something else there?
I think that's a great question. And I do see them as an expensive protocol. So they're effectively doing is that they're increasing the circulating supply of these tokens and essentially diluting that value token holders compared to investors. So what I would say here is that the fine line to walk is can you grow much faster than your token emission? And that's a really good way to look at it. So it's kind of like looking at the traditional markets. If your GDP is growing at 3%, but inflation is at 5%, essentially you're not growing. So how can we capture that the growth of the network is in relation to its token incentives mechanism? So not because it's an expense, means that it's bad, but it just means that it needs to be justified.
That's very true. And I actually just 2 days ago had a discussion with Kane, founder of Synthetics. And that's been one community where we've been going a bit back and forth because they have a different type of incentive model a little bit where SNX stakers are incentivized to stake. But then again, so SNX stakers aren't diluted away, but then non-SNX holders, if you purchase purely the token, then you would be diluted away, which kind of forces people who want to be non-diluted to stake, which also means becoming an LP and taking on additional risk. So do you, as a venture fund, when you purchase a token, are you able to stake it? How do you act like within DeFi?
Great question. And I think it's an excellent example that you gave about Synthetics. It's the same case for Ethereum. The ETH token that's not getting staked is essentially getting diluted by the rewards that the staked ETH token is earned. So as an investor, what we do is that we would stake a majority of our positions because what happens is that if you're long a given token, you're long the project and you should feel comfortable staking a token if you're comfortable investing and long a certain project. Now, the thing is basically access to liquidity again can be very important. So you might stake a portion of your total tokens. Yes, we do stake.
Okay, got it. Yeah, I think that's a great insight. Thank you. Now, I was wondering before we wrap this up, given everything we've spoken about your thesis, etc., would you be able to walk me through like a case example of any of your recent investments on what really caught your eye there and why you made that investment?
I have pretty good thesis on Lido and GMX, but I'd rather skip these because I feel like they're very well covered in the market today. So with your permission, maybe I can speak about a token that I'm still developing my thesis on.
Of course. Yeah, that would be interesting.
The token in question in the project is Blur. And I think that what Blur has achieved in such a short period of time, a sector that has product market fit, as you mentioned, the NFT marketplace sector is one with strong product market fit already, is really fascinating. There's been attempts at displacing OpenSea during a more exciting market where NFT trading volumes were much higher. And these attempts have failed. I think what Blur is doing is a very interesting experiment that is yet to play out. But so far, I've been extremely impressed with how it's playing out. So I'll start high level. I think NFT marketplaces have the potential to look like e-commerce giants selling goods online if you look at the e-commerce space, Amazon has more market share than the rest of the top 20 combined. So if digital collectibles, if NFTs play out in the same way, one NFT marketplace could end up being a massive winner in the space, mainly because the network effects that it builds around its liquidity, lending programs, staking programs, etc., will be extremely hard to displace. Second thing I would say is the team has shown relentless execution. They've been shipping great products. They're accelerating price discovery for NFTs, whether you like them or hate them. And as importantly, they seem extremely well aligned to the ethos of Web3. Launching a token for a US based company is not an easy feat, but really what it does, it allows their users to participate in the value accrual of their company. It's basically, it ties it back to liquid venture, where like OpenSea latest valuation was 12 billion, and it was for a close group of lucky investors that were able to participate. What they agreed on is they agreed on an investment with an undetermined period of time. Here, that's where you still have access to your liquidity, right? Because if they stop delivering, you can always get out of your investment. I think users and usage and key metrics are super interesting. I think while Blur has a little more than 2 times less the number of users, it has about 5 times more the trading volume. And they've attracted power users and, of course, incentives and airdrop farmers. But the average user on Blur trades 13 times more volume than the average user on OpenSea. The very important metric to keep tracking is going to be retention as these incentives start winding down. But I think Blur is a super interesting project to keep in mind and keep watching. And we're slowly forming a thesis there. As the price drops, it's looking more and more attractive. And more importantly, I think that talking to users, they're really starting to form product habits about using Blur. It's the first thing they think about when they want to build it about buying an NFT. They're used to the flow. Because of this, I think this has the potential to be very sticky.
Thank you for sharing that thesis. That's really interesting insight to hear how you're thinking about that. And I do agree, like their focus on more professional or more sophisticated traders, especially from the get-go, has been really interesting in terms of like the average order of average trade value that you'd say that they bring in. So that volume, and then just aggressively bringing down fees to kind of force OpenSea and all other competitors. It's been a very interesting market dynamic to follow. I think the NFT space, thanks to Blur, they didn't come to play around. So now I'll wrap this up with one final question. We spoke about what you are excited about in terms of the biggest potential tech unlocks that could really kind of push this space forward. And also you're looking into layer twos, but on top of mind right now, when you hop off this call, what are you going to go back to focusing on? What is like the main thing that excites Chris right at this moment?
That's a great question. And I think that I'll tell you what's super exciting in crypto right now for me, not necessarily right after this call, but basically what's super exciting. I think I'm truly fascinated with generative art. I think it's such a fascinating space. It's really redefining what art is about. It's creating artists out of designer, algorithm developers, movie designers, by tokenizing their craft, mixing it with algorithms, creating something truly magical that we've never seen before, being powered by algorithms under the hood. So that I think is a space that is super fun to watch. It's super exciting. And we're really witnessing a little revolution in the art space, I think. And it'd be really interesting to ask, like, do you think one day art critics are going to evaluate generative art based on fundamentals?
Maybe. I hope so. We're going to start building generative art dashboards. Maybe that's next on Token Terminal's roadmap. Try to quantify everything related to that. Thank you, Chris. This was a really great overview and deep dive into your mind as an investor in this space. And I'd say the biggest differences between more traditional VC and then crypto and what liquid venture introduces. So it's been really insightful. And I hope that we can do it again at some point to maybe dive deeper into the thesis behind some investments that you make or whatever topics as this space keeps maturing. Appreciate your time. Thank you.
Absolutely. That was fun. Thank you for the opportunity.